This is U.S. Benefits Reports, bringing you the latest serious updates on potential changes to Social Security benefits as we enter January of the new year, where already 4 significant developments have emerged that could profoundly affect everyone receiving these crucial benefits. And in this detailed examination, we will delve deeply into each of these 4 potential huge changes, drawing directly from the current discussions and proposals circulating in Congress and beyond, ensuring that beneficiaries are informed about what might be on the horizon without speculating beyond the established facts. Starting with the foundational context, it is only the beginning of the year, yet these 4 alterations are already making waves, potentially reshaping the landscape for Social Security recipients across the nation. And as part of our commitment at U.S. Benefits Reports to provide comprehensive coverage, we will outline each one methodically, beginning with the first proposal, which involves a substantial emergency increase aimed at addressing ongoing economic pressures. This initial change centers on a bill that has been introduced in Congress proposing a $1,200 emergency boost spread over 6 months, translating to an additional $200 in every single monthly check during that period, with the explicit goal of offsetting the inflation that has persisted and which the standard cost of living adjustments have failed to adequately match, thereby offering some relief to those relying on these payments to cover rising expenses in essentials like food, housing, and healthcare. According to reports from reliable sources such as CNBC, this initiative is designed to assist Social Security and Veterans Affairs beneficiaries in coping with elevated prices, and it is being championed by a group of Democratic senators who are advocating for this temporary increase of $200 per month for a duration of 6 months, with the legislation known as the Social Security Emergency Inflation Relief Act garnering support from figures including Mark Kelly of Arizona, Alex Padilla of California, Tammy Duckworth of Illinois, Angela Alsobrooks and Chris Van Hollen of Maryland, Elizabeth Warren of Massachusetts, Tina Smith of Minnesota, Kirsten Gillibrand and Chuck Schumer of New York, Ron Wyden of Oregon, and Peter Welch of Vermont, all of whom are Democrats pushing for this measure to provide immediate financial breathing room. Under the terms of this proposal, the extra $200 per month would enhance benefit payments through July of the current year, applying broadly to individuals who receive benefits from Social Security, supplemental security income, railroad retirement, veteran disability compensation, and veteran pensions, thus encompassing a wide array of recipients who could benefit from this infusion of funds to mitigate the effects of inflation that has outpaced adjustments in recent times. Notably, while this bill currently has backing solely from Democrats, there is potential for broader appeal, as evidenced by separate discussions involving President Trump and some Republicans who have expressed support for a different form of stimulus, specifically a $2,000 check per person funded through tariff revenue, which raises the possibility of compromise, where Republicans favoring the $2,000 payments and Democrats advocating for the $1,200 boost to Social Security beneficiaries might find common ground, perhaps by directing tariff revenue toward this targeted relief for those on fixed incomes, thereby creating a bipartisan pathway to enactment that could deliver meaningful support without necessitating entirely new funding mechanisms. This intersection of ideas is particularly intriguing because Trump has already referenced sending out what he termed a warrior dividend, which he attributed to tariff revenue, although it was clarified that those funds were part of the tax cut extensions and expansion bill signed into law back in July, suggesting that similar creative financing could be applied here to make the $1,200 emergency increase a reality for Social Security recipients. And at U.S. Benefits Reports, we are closely monitoring these developments to see if such collaboration materializes in the coming months. Moving seamlessly to the second major potential change, which revolves around the elimination of taxes on Social Security benefits, a topic that has gained traction following recent legislative actions and could further alleviate financial burdens for millions of seniors and other beneficiaries who currently face taxation on their payments under certain income thresholds. Prior to the recent changes, only around 50% of beneficiaries actually paid taxes on their Social Security benefits. But with the passage of the One Big Beautiful Bill Act, which introduced enhancements like an extra standard deduction of $6,000 for individuals and $12,000 for couples filing jointly, this has expanded the tax relief significantly, resulting in the vast majority, specifically 88%, of all seniors receiving Social Security now paying no tax on those benefits, as confirmed by a brand new analysis from the Council of Economic Advisers and statements directly from the White House, emphasizing that under this bill, the vast majority of senior citizens, 88% in fact of all seniors who receive Social Security, will pay no tax on their benefits. However, the push does not stop there, as both Republicans and Democrats in Congress are actively urging the White House to go further and completely eliminate taxes on Social Security benefits for all recipients, regardless of income levels, which would represent a complete overhaul of the current system and provide even greater financial security for those who have contributed to the program throughout their working lives, potentially allowing them to retain more of their monthly checks to cover living expenses in retirement. Whether this full elimination will occur this year remains to be seen, but the bipartisan interest signals a strong possibility. And at U.S. Benefits Reports, we will continue to track the progress of these efforts to inform our audience about any advancements that could lead to tax-free Social Security payments becoming the new standard, ensuring that beneficiaries are prepared for what might come next in this evolving policy landscape. Transitioning to the third significant proposal, which focuses on updating the asset limits for individuals receiving supplemental security income, or SSI, a program that provides essential support to disabled and elderly Americans, but has long been criticized for its outdated restrictions that penalize saving and financial preparedness. And this bipartisan initiative aims to rectify that by substantially increasing those limits to better reflect modern economic realities. Currently, for an individual receiving SSI, the asset limit stands at $2,000, meaning that exceeding this threshold could result in the loss of benefits, while for couples, it is set at $3,000, not even double the individual amount, which has been seen as particularly punitive. And these figures have remained unchanged for decades, failing to account for inflation or the rising costs associated with emergencies and daily living. Under the new bill introduced by U.S. Senator Bill Cassidy, known as the SSI Savings Penalty Elimination Act, these limits would be raised to $10,000 for individuals and $20,000 for married couples, with the added provision that these amounts would be indexed to inflation going forward, allowing them to increase annually to maintain their value over time and prevent the need for future legislative interventions every few decades. This reform is intended to allow older and disabled Americans to save for emergencies and their futures without risking the benefits they depend on to live, addressing a system that has not been updated in nearly 40 years since the last changes were passed by Congress in 1984 and took effect in 1989, thereby punishing those who attempt to build even modest financial cushions. Senator Cassidy's legislation has garnered attention for its potential to modernize the Supplemental Security Income Program, and as detailed in official statements, it would reform the program to ensure that disabled and elderly Americans can prepare themselves for financial emergencies without putting their essential benefits at risk, marking a long overdue adjustment that could empower recipients to achieve greater stability. At U.S. Benefits Reports, we recognize the importance of this proposal in fostering self-sufficiency among SSI beneficiaries, and we will be following whether it gains the necessary support to pass in the current year, providing our viewers with updates on this critical issue that affects some of the most vulnerable populations. Finally, the fourth potential change that could materialize this year is a comprehensive reform effort dubbed the Big Idea, spearheaded by Senator Bill Cassidy in collaboration with others, aimed at averting the projected benefit cuts set to occur in 2032 if no action is taken, which could reduce payments across the board by up to 26%. And this ambitious plan seeks not only to prevent those reductions, but potentially to enhance benefits as well, through innovative financing and investment strategies. This proposal is being developed with input from the Bipartisan Policy Center, where lawmakers are increasingly vocal about the urgency of addressing the depletion of Social Security's primary trust fund, projected to lead to a 23% cut in benefits by 2032, and the center advocates for a balanced package of tax and benefit adjustments to shore up the program's finances while strengthening support for those who rely on it most, especially in light of the shrinking timeline for action. Senator Bill Cassidy, a Republican, is leading this effort and has secured support from Senator Tim Kaine, a Democrat, highlighting its bipartisan nature. And the core of the big idea involves creating a $1.5 trillion investment fund sourced from general revenue with the fund's returns, to the extent they exceed the interest costs on the additional $1.5 trillion of debt, being credited back to Social Security over a 75-year period to ensure long-term solvency. Key details include structuring this as a sovereign wealth fund operating separately from the existing Social Security trust funds, with funding achieved by borrowing $1.5 trillion over 5 years at a rate of $300 billion annually, and proponents argue that this would not increase the national debt net because the money would be held in escrow and invested with the potential to repay the initial borrowing through generated returns. In terms of investment strategy, unlike the current trust funds, which are limited to low-yield U.S. Treasury bonds, this new fund would pursue a diversified portfolio including higher return assets such as stocks and bonds, akin to a 401k plan or the Federal Railroad Retirement System, allowing for greater growth potential over the long term. The fund would be permitted to accumulate returns for 75 years, with those earnings expected to cover the program's projected shortfalls and potentially render it solvent indefinitely, while importantly, the plan incorporates protections for current and future beneficiaries, ensuring that individuals bear no investment risk and that promised benefits continue to be paid regardless of market fluctuations, thus safeguarding the reliability of payments. This big idea represents a forward-thinking approach to Social Security reform, bringing together Republicans and Democrats to prevent the looming cuts and possibly expand benefits. And at U.S. Benefits Reports, we are dedicated to providing in-depth coverage of this proposal as it progresses through Congress, potentially landing on President Trump's desk for signature into law this year. In summarizing these 4 proposals, the $1,200 emergency increase via the Social Security Emergency Inflation Relief Act, the push to eliminate all taxes on Social Security benefits, building on the recent expansions that already exempt 88% of recipients, the SSI Savings Penalty Elimination Act to raise asset limits to $10,000 for individuals and $20,000 for couples with inflation indexing, and the big idea to establish a $1.5 trillion investment fund to avert 2032 benefit cuts. We see a landscape ripe for action that could significantly impact beneficiaries. And while each has its own merits and challenges, their potential bipartisan elements suggest that compromise is possible in addressing inflation relief, tax burdens, asset restrictions, and long-term solvency. As we at U.S. Benefits Reports continue to monitor these developments closely, it is clear that the early months of the year are already setting the stage for potentially transformative policies, with the emergency boost offering short-term aid through $200 monthly additions over 6 months to counter inflation's bite, the tax elimination effort aiming to make benefits fully untaxable beyond the current 88% exemption achieved via the One Big Beautiful Bill's standard deduction increases, the SSI asset limit reform seeking to update decades-old caps that currently stand at $2,000 for individuals and $3,000 for couples to more reasonable $10,000 and $20,000 thresholds adjusted annually for inflation under Senator Cassidy's bill, and the comprehensive big idea proposing a separate sovereign wealth fund seeded with $1.5 trillion borrowed over 5 years and invested in diversified assets to generate returns that cover shortfalls and protect against the 23 to 26% cuts projected for 2032, all while ensuring no risk to individual beneficiaries. These initiatives, if enacted, could provide much-needed enhancements to the Social Security system. And drawing from the details, the Emergency Relief Act, backed by Democrats like Mark Kelly, Alex Padilla, Tammy Duckworth, Angela Also Brooks, Chris Van Hollen, Elizabeth Warren, Tina Smith, Kirsten Gillibrand, Chuck Schumer, Ron Wyden, and Peter Welch, would extend through July with applications to Social Security, SSI, railroad retirement, veteran disability, and pensions, potentially merging with Republican ideas like Trump's $2,000 tariff-funded checks for broader support. Similarly, the tax relief expansion, already benefiting the vast majority, as per White House and Council of Economic Advisors analyses, has cross-party advocates pressing for total elimination, which could happen amid ongoing congressional pushes. The SSI reform, unchanged since 1989, would empower savings without benefit loss, as emphasized in Cassidy's legislation to reform a program punishing preparedness. And the big idea, supported by Cassidy and Caney through the Bipartisan Policy Center, envisions long-term growth via higher yield investments, borrowing $300 billion annually for 5 years without net debt increase due to escrow and returns, mirroring successful models like railroad retirement to indefinitely sustain the program. At U.S. Benefits Reports, we emphasize that these are proposals under consideration with the potential to pass this year, and their implications for inflation offset, tax savings, asset flexibility, and solvency are profound, warranting close attention from all affected parties as Congress deliberates. Expanding further on the first proposal, the $1,200 boost over 6 months at $200 per check is specifically tailored to bridge the gap where cost of living adjustments have lagged behind inflation, as noted in the senator's rationale, and its inclusion of multiple benefit types underscores a holistic approach to relief for vulnerable groups. The Democratic backing, while currently partisan, opens doors for integration with Trump's tariff revenue concepts, where the warrior dividend precedent from July's tax bill could pave the way for using similar funds to support Social Security specifically, perhaps achieving the bipartisan consensus needed for passage. On taxes, the shift from 50% taxation pre-bill to only 12% post the One Big Beautiful Act's deductions highlights progress, yet the full elimination advocated by both sides could complete this relief, allowing full benefit retention. For SSI, the stagnation since 1984 demands the proposed increases to $10,000 and $20,000, indexed to inflation, to prevent emergency savings from triggering benefit cuts, as Cassidy's Act aims to eliminate this penalty. The Big Idea's 75-year horizon, with protections against market risks, positions it as a sustainable fix, borrowing to invest diversely, and credit returns to Social Security, potentially averting cuts and enabling increases. These 4 changes, if realized, could mark a pivotal year for benefits, and U.S. Benefits Reports will keep providing serious, fact-based updates as events unfold.